Hello, my name is Akmal Al Hussaini, and I'm going to be explaining about 6.1, the role of financial management. In smaller companies, the owner is responsible for the financing risks, but for larger companies, it's usually managed and handled by the finance department. If anything goes wrong, they are the one to be blamed. Finance has its role, and those roles and they also consist of three. One of them is balancing short-term and long-term demands, right? So a company must have cash ready to pay salaries, tax, and bills. They may also need cash and money for acquisitions of assets or other extraordinary expenses. Second is balancing potential risk and potential rewards. So every decision involves a risk and return trade-off, and a higher risk may yield higher rewards. The safest choices aren't always the best choices. The last goal is balancing leverages and flexibility. The company can use debt strategically and sometimes out of necessity. So debt can be a tool or a trap. So debt can be a tool if it's good, and one of the ways to use debt in a good way is to buy property. Buy property, anything that can produce revenue. That's those debts are categorized as good debt. And if certain debts if it's and then if a debt can be categorized as a trap because they are bad. So bad debt consists of costs, they consist of unnecessary machineries, they consist of sort of unnecessary things that would eventually lead to a company not gaining revenue but having losses along the way.
The budgeting process. Budget shows where and when the money will be spent during the year. Managers use it to make comparison between actual results and projections to make adjustments. Next, we have the budgeting challenges. First, budgeting is a challenge because the money is finite. Managers always make tough decisions and won't please everybody. Second, managers can predict revenue accurately because some costs are fixed but some are not. Variable costs can change and make the revenue become unpredictable. Lastly, managers are not confident to spend the budget. They usually use last year's budget but often leads to inaccurate data. Some use zero-based budgeting but require more efforts and time. Next, I will explain to you about types of budget. There are 4 types of budget. First, we have the startup budget. It identifies all money needed to get a new business get off the ground. The biggest concern here is the burn rate on how quickly the company is spending its funds from initial investor before they begin making their own money. Next is the operating budget. It identifies all revenue sources and balance that income. Managers use this to predict cash flow and making sure the company have enough money to keep operating. Next, we have the capital budget like real estate, new facilities or major equipment. These investments are so expensive and often require long-term planning. Lastly, the project budget covers specific goals like research and development or moving to a new office. Project managers are responsible for predicting the cost and ensuring the work is completed without going over the limit.
For my part, I'll be presenting 6.3 financing alternative factor to consider. The first one is about the debt financing versus equal financing, which explain that debt must be repaid and offer tax break, but it will involve higher risk, while equity involves sharing ownership and profit, but doesn't require fixed repayment. The next one is about the term length. There's 2 of them. The first one is short-term financing, and the second one is the long-term financing. For the short-term financing, it takes within 1 year for immediate operation needs like inventory, and for long-term financing, the repayment period is more than 1 year and possibly even decades. The purpose of it is for strategic goals like real estate or R&D. For some company, they will take some decision factor such as nature of the spend, the company current financial health, interest rate, repayment capabilities, and overall business growth. So the next one is about the cost of capital. Using a company's own cash to grow means no interest payments, but it still has an opportunity cost, the value of the best alternative use of that money. Sometimes it's smarter to invest excess cash as well and borrow funds to grow the business. So the first one is about the risk. What is risk? Lender want higher returns from riskier company. A strong financial reputation help business get cheaper financing. The second one is about the interest rate. Interest rate change over time even for a strong company. Prime interest rate is the lowest rate for top borrower on short-term bank loan. So the last one is about the opportunity cost. Opportunity cost means using your own money for growth might seem free, but it could miss better investment chance as well. That's all for me.
Next topic is short-term debt. Short-term debt is used to cover short-term financial needs. There are 5 main topics. First is credit cards. Credit cards provide quick and easy access to short-term financing for small or urgent expenses, but they charge high interest if balances are not paid in full. Therefore, users need good financial discipline to avoid overspending and financial problems. Second is trade credit. Trade credit allows business to purchase goods now and pay supplier at a later date, usually without interest if payment is made within the agreed period. And it also helps improve cash flow while building long-term relationship with suppliers. Then, secured loans require collateral such as property or equipment, which is reduce the lender's risk and allow lower interest rates. But borrowers face the risk of losing the asset if they fail to repay the loan. Next, unsecured loans do not require collateral and are approved based on borrower's creditworthiness. However, they involve higher interest rates due to greater risk and are mainly suitable for short-term financing needs. And last, commercial paper is a short-term debt instrument issued by large and financially stable companies to meet working capital needs, offering lower interest rates than bank loans, but it usually has a short maturity period of less than 1 year.
In addition to short-term financing, companies also rely on long-term debt to fund mature and long-lasting investment. So while long-term debt is similar in concept to short-term borrowing, the longer repayment period creates different consideration for both borrowers and lenders. So long-term financing is commonly used for large expenses and strategic growth. The main long-term debt alternative include long-term loans, leases, and corporate bonds. Long-term loans, also known as term loans, usually have maturities ranging from 1 to 25 years, and depending on the lender and the purpose of the loan. And they are commonly used to buy real estate, expand facilities, purchase equipment, refinance debt, or provide working capital. And these loans allow companies to reach large amounts of capital without giving up ownership. And however, not all firms qualify, as lenders carefully assess the borrower using the 5C of credit, which is character, capacity, capital, conditions, and collateral to ensure the company can repay the loan. Leasing is an alternative to borrowing money to buy assets. In a lease agreement, the asset owner, known as the leaser, allows another party, the lessee, to use the asset in exchange for regular payments. Unlike renting, leases have fixed terms for a specific period of time. Leasing is commonly used for real estates, vehicles, and major equipment. It is especially suitable for companies with limited capital or poor credit ratings, as creditors prefer leasing because the asset can be repossessed if the firm fails. And overall, leasing provides flexibility and help firms access expensive assets without large upfront costs. When a company needs to borrow a large amount of money, it can be issue corporate bonds to many investors instead of borrowing from a single lender. So corporate bonds are debt certificates that require the company to repay the principal plus interest on a specific date, and bondholders act as the lenders. There are several types of bonds, including secured bonds backed by asset, debentures which are unsecured and riskier, and convertible bonds that can be exchanged for company shares. And to manage repayment, companies may use bonds, sinking funds, or callable bonds to reduce financial strain and improve cash flow.
Hello, my name is Akmal and I'm going to be presenting about 6.6 financing alternatives equity. So, equity financing is the process of raising capital by selling ownership stakes or shares in a company to investors in exchange for cash. There are countless types of ownership, but the top two are venture capitalists and public stock offerings. So, what does it mean by venture capital and other private equity. So they are professional investors who provide capital for early stage and high growth company in exchange for an equity stake, which is ownership. They directly and indirectly plays a huge role in the economy by giving both individual and institutional investors opportunities to increase capital by investing in shares. So what does it mean by public stock offerings? So public stock offerings is when a company sells its shares to the public to raise capital, allowing everyday investors to buy ownership for the first time. They have access to vast amounts. In this way, they have access to vast amounts of capital, liquidity for early investors, but risk of company losing control if shares bought are higher than 50% by the public.